IFRS S1 and S2 will become effective in Malaysia in 2025 for large listed companies on the main market, with other main market listed companies following in 2026, and listed issuers on the ACE market and large non-listed companies in 2027.
Now, before I answer this question, allow me to recap the National Sustainability Reporting Framework, also known as NSRF, which was launched on 24 September 2024. The purpose of the NSRF was to ensure applicable companies in Malaysia produces consistent, comparable, and reliable sustainability information. By doing so, this will enhance Malaysia's competitiveness and attractiveness to investors. There are 4 key elements I wish to highlight about the NSRF. Number 1, climate-first approach. The prioritization of climate-related disclosures will support Malaysia's net zero goals. Companies are encouraged to provide clear, accurate data on their climate risks and opportunities to facilitate informed decision-making. Number 2, phased implementation. The NSRF provides a phased approach to sustainability reporting, allowing companies to gradually adopt the ISSB standards. This approach ensures that companies of different sizes and levels of readiness can implement reporting processes in stages, giving them time to build capacity and align with global standards. Additional transition reliefs. To ease the adoption of sustainability reporting, additional transition reliefs are made available under the NSRF. These include focusing on climate-related disclosures, first, and allowing additional time for more complex reporting, such as Scope 3 GHG emissions. This allows companies to report their sustainability and climate-related disclosures at a manageable pace. And finally, number 4, PACE, also referred as policy, assumptions, calculators, and education. PACE provides tools and guidance to help companies meet their sustainability reporting requirements. This includes access to policy guidance, emission calculators, and capacity building programs, ensuring companies have the resources they need to comply with the NSRF. Alright, back to the question. And I agree that one can be overwhelmed with the requirements, mainly because this is new to most of us. I want to highlight 3 things for preparers to focus on. Number 1, look out for further developments on PACE. Some policy-level resources are already available. Calculators and capacity building programs are currently being developed. Number 2, clear understanding on the planned implementation, including available transitional release. 2 examples here. Number 1, under climate first reporting under IFRS S1, disclosures of other sustainability-related risks and opportunities is required only from the 2nd year onwards. And for IFRS 2, disclosures of Scope 3 GHG emissions is not required in the 1st year of applying IFRS S2. And finally, number 3, commitments from the board and the board of directors and collaboration across organization, including establishment of dedicated team, is paramount for a successful implementation. If need be, please get external assistance. Let's start first with IFRS S1. IFRS S1 sets out the general requirements for a complete set of sustainability-related financial disclosures and requires an entity to disclose information about all sustainability-related risks and opportunities that could reasonably be expected to affect the company's prospects. The effect of the company's prospects refers to the effect on the company's cash flows and its access to finance or cost of capital over the short, medium, or long terms. The information required by IFRS S1 relates to general aspects of how an entity operates, in particular 4 areas. Number 1, governance. Number 2, strategy. Number 3, risk management. Number 4, metrics and targets. All within the context of sustainability-related risks and opportunities. IFRS S1 refers to these 4 aspects as the core content, meaning information that is essential to users' understanding of how an entity identifies, assesses, prioritizes, monitors, and manages sustainability-related risks and opportunities. The focus on core contents builds on widely accepted recommendations of the TCFD. Okay, to the question, let's now discuss about the first of the four aspects, which is governance. The objectives of governance disclosures in IFRS S1 is to enable the readers to understand the governance processes, controls, and procedures a company uses to monitor, manage, and oversee sustainability-related risks and opportunities. To help readers evaluate whether and how much attention is given to sustainability-related risks and opportunities, IFRS S1 requires disclosure of, number one, the governance bodies or individuals with oversight of a company's sustainability-related risks and opportunities. And number two, the management role in governance processes, controls, and procedures used to monitor, manage, and oversee sustainability-related risks and opportunities. Governance here may include boards, committees, or equivalent bodies charged with governance. As an example of a large listed company, there could be 4 layers of governance. Layer number 1, the board of directors. Layer number 2, board risk and sustainability committee. Layer number 3, management sustainability committee. And layer number 4, sustainability working group. From a scalability standpoint, there could be more layers for even larger organizations or more compact governance structures of small organizations. Specifically, IFRS S1 acknowledges that for some organizations, the oversight responsibility may be held by individuals rather than governance bodies. ISSB sustainability standards follow a single materiality concept. What this means is that after identifying all the sustainability-related risks and opportunities that can affect the company's prospects, it is essential to determine which of those are material. And in line with the definition of materiality in IFRS reporting, information is considered material if omitting, misstating, obscuring, it could reasonably be expected to influence decisions that readers make based on that information. While double materiality is not specifically required for IFRS S1, I thought it's good to introduce the concept of double materiality as it is probably new to many of us. 2 key elements here. Number 1, impact materiality. This is an inside-out concept. It relates to a sustainability matter that pertains to the company's material, actual or potential, or negative impacts on people or the environment. And it is determined by 2 perspectives. Number 1, severity of impact, and number 2, likelihood of impact. The second concept is relating to financial materiality. It's an outside-in concept, so it's a bit opposite to impact materiality, the first one. It relates to a sustainability matter that triggers or may trigger material financial effect on the company by generating risks or opportunities that have an influence on the company's financial performance. 2 perspectives here: size of the potential financial effects, and B, likelihood of occurrence. Take climate change as an example. From impact materiality standpoint, a company's greenhouse gas emissions contributing to global warming would be a negative impact under impact materiality. From a financial materiality standpoint, may result in increased regulatory fines for non-compliance with environmental regulations and potential litigation from stakeholders affected by climate change. I would like to begin with a positive statement that financial auditors currently have many skill sets and competencies that are highly transferable to sustainability assurance. Examples of these skill sets and competencies include number 1, independence, number 2, professional skepticism, number 3, auditing techniques such as sampling. In fact, the new International Standard on Sustainability Assurance, ISSA 5000, was developed from existing IAASB standards and guidance currently used by financial auditors, namely ISAE 3000 and ISAE 3410. Of course, I agree that with anything new, there are specific knowledge gaps which financial auditors are currently facing in sustainability assurance space, and to keep it simple, I will categorize these gaps into two. Category number one, more general matters that are applicable in financial audits. Examples include IFRS S1 matters pertaining to governance, strategy, and risk management. As financial auditors would have experience assessing or reviewing these matters as part of financial audit process, I do not foresee such a big knowledge gap for Category 1 areas. Category 2. These are more specialized matters such as assessing greenhouse gas emissions. There are possibly some simpler GHG emissions that can be assessed by financial auditors, provided they are adequately trained. These could include stationary combustion in GHG Scope 1 or purchased electricity in GHG Scope 2. However, many assurance work in GHG emissions, particularly in GHG Scope 3, would require specialist resources and teams. Over time, I do expect the knowledge gap to reduce and financial auditors to take more areas within the overall sustainability assurance space. I would like to start with NSRF expectations. Reasonable assurance to be undertaken for Scope 1 and Scope 2 GHG emissions starting from 2027. The principles of reasonable assurance under ISSA 5000 are like the principles financial auditors apply during financial audit or financial assurance engagements. These includes elements of control testing and substantive audit procedures in order to evaluate the quality and integrity of the data provided by management. From what I can see, during several sustainability assurance work completed so far, these GHG emissions data were mostly not required to be reported before, let alone were audited previously. Therefore, the preparation of these data by management may not have gone through the same level of rigor or scrutiny compared to financial data. Take air condition as an example. The organizations may have air-conditioned units documented in the fixed asset registers, but may not have the horsepower associated with the air-conditioned units documented in the fixed asset register. My suggestion is that the auditors and the organization to prioritize to elevate the level of data quality and governance surrounding data quality prior to reasonable assurance requirements kicking in from 2027 onwards. This could be in the form of implementation or pre-assurance engagements exercises. With over 1,000 companies listed in Bursa Malaysia main market and ACE market currently, and these numbers have not included the large non-listed companies, sustainability assurance cannot be executed by specialist teams alone. Audit and other firms qualified to undertake sustainability assurance engagements from 2027 onwards must be able to scale up with quality over the next few years, and unfortunately the journey has to start yesterday. In building sustainability assurance capabilities, I would like to touch on 3 areas. Number 1, gaining experience in sustainability reporting and sustainability assurance prior to mandatory sustainability assurance date of 2027. Firms would need to build an ecosystem where the teams are already executing work in both the general areas of sustainability reporting and sustainability assurance, and also the more specialized and complex areas. This would help build credentials and experience. Secondly, sustainability assurance methodology. If not already developed, it is paramount for audit and other firms to establish a sustainability assurance methodology based on internationally recognized standards and frameworks. This will ensure high quality standards and consistently attained for these engagements. And finally, number 3, recruit and train. Due to the breadth and depth of the market demand in sustainability reporting and sustainability assurance, existing headcounts may not be able to cope. Therefore, hiring new talent is necessary. Additionally, many existing financial auditors will need to be trained to close the knowledge gap. Training programs will need to be established so that all appointed assurance providers are accredited to execute sustainability assurance engagements when the time comes.